my name is Maxime. I work for a VC and accelerator fund called Catalyst Fund, focused on investing in climate resilient startups across Africa. And I'm also the co-founder of Africa the Big Deal, where we track all the startup investments across the continent and produce a couple of insights every week on this topic. So yeah, I mean, I'm not sure how much data you want me to share straight on, but yeah, we to go from the helicopter view. I was checking the number just before the call, and if we look at the amount of funding that went to startups in Africa this year, we are now at a little bit over 4.7 billion, close to 4.8 billion, which compares to about 4.6 last year. So there's already a little bit of growth. I mean, it means that we have basically passed last year's record amount of funding, and we are now seeing a little bit of growth. Clearly, it would not be a double-digit growth, but we might see 5-6% of growth year on year in terms of startup funding, which is quite unique globally. So if you compare with any other region, that's not at all the case. There's actually a decline everywhere else. Of course, this is mainly driven by the first half of the year, and we have seen a slowdown in the second half of the year. But there's, I mean, in terms of amount of deals, number of deals, there's still been a significant amount of deals even in the second half of the year. Just another quick point here, what has been interesting and that explains the slowdown in the second half of the year is the reduction in terms of what we call the mega deals, so deals above $100 million. So there's a drop of about 30% of them compared to last year. But in the meantime, you have 15% growth in the number of deals that are above $1 million compared to last year. So overall, there's more deals also above $1 million, but less deals above $100 million. And because of the absolute size of the ecosystems, I mean, 4.8 billion is big, but it's not that big compared to other regions. Therefore, the weight of those mega deals is still very important and explains the slowdown. So if you don't see as many 100 million, 200 million, 300 million dollars deals, of course, it impacts disproportionately the total amount of funding for the year. A quick word on sectors. We are seeing still obviously fintech leading the pack. However, the ratio of fintech and the percentage of the total funding is slower than it's ever been in the past 2 years. So last year we were at more than half of the funding that went to the fintech sector. This year it's closer to 36-37%. So there's a bit of a slowdown on that front. Sectors that we see increasing: logistics and transport, energy, and also what we would typically call environment and climate related sectors that are growing quite a bit this year. And I will finish with the geographies. We are still obviously seeing the big four: Nigeria, Kenya, South Africa, Egypt, leading the pack. There's a little bit less concentration in those four than it was the years before. I mean, previously we were around 80-85%. This year we're at 75% of the funding that goes to these four markets, which means more funding going to the remaining countries, and that's a good news. But even between those four, there's strong disparities. We're seeing significant growth in terms of amount of funding in markets like Egypt and Kenya, and then lesser so obviously in Nigeria, and especially less so in South Africa. Yeah, that's maybe it in terms of the overall numbers. I think I've spoken more than enough.
Thank you very much. I can imagine that there's a lot to share. There's a lot of context and nuance, but yeah, it does help actually. Thank you very much. 4.8. That's good. And then, when you spoke about us not like the mega deals not happening, I mean, you reminded me that I don't think there's been any unicorn this year. So yeah, I mean, the mega deals tend to come with that. But thank you for sharing, Maxime. Dario, over to you.
Hey guys, thank you. Good to see you. As Zach said, it's been a long year. It's good to see you all. Myself, a founder of a company called Brighter Bridges. We do business intelligence in emerging markets, especially Africa. I actually wanted to probably start from. I think Maxime posted something recently around the fact, and everyone really is talking about the fact that we're moving from a few months of it being a founders market to it being an investor market. And I don't want to duplicate the data conversation. I wonder whether some of the questions that I've gotten excited about this year could be one of the subjects of this conversation. And for instance, one of first of all, we looked at the last 15 years of funding across Africa, and any possible metric, save for maybe the variation between the valuation last year and this year, have actually grown over the past 15 years. So the number, any metric that you can possibly find. So the number of companies founded over time, the number of investors that enter the space over time, the number of financial instruments that you find over time, the amount of funding that gets put into Africa. I think there is this little discrepancy between 2020, 2021, and 2022. But I think it's very important to mention the fact that announcements hardly ever match the signature of the funding. The fact that a lot of deals in 2020 got announced in 2021, and the fact that probably a lot of deals that are supposed to be happening right now are going to be announced next year. And for all of us that track all of these announcements, it gets very tricky because it's practically impossible for us to get a sense of when exactly the signature happens, how the actual composition of the deal is. So sometimes, like, you announce a $5 million deal that is composed by 3 different transactions that happen at different times during the year. So it's like when you actually start drilling down into the actual work of doing this, it's very problematic. So all I also want to say about this is the tracking exactly how much money is raised in each of these years is hard, but that's not even the point. If you actually look at over a course of a larger time frame, which is the last 10, 15 years, you can see how things have changed. The number of companies that have raised a certain amount, let's say 50 or $100 million, has grown significantly. This obviously we can also lead to a conversation around whether that $100 million was well spent and now the companies are worth more than that, or whether some of these companies are actually gone down. We've seen some of the valuation being slashed by a significant percentage, right? And another topic that I think it's very important is the role played by the few mega deals that obviously bring the numbers up, and who exactly put the money into these companies and where are these investors now, right? A lot of conversation has happened around how do people call them? Safari investors or tourist investors? There's some funny definition for this. And one of the conversations that is happening right now is, okay, where does the capital come from? And what is the role of those 10 to 15 investors that have written tens of $1 million checks and into a few companies? And where are they going to be now that the market looks like it's kind of retrenching? It looks like it's becoming a bit more conservative, right? Because now we have a lot of companies that have raised at inflated valuations, that have raised significant amount of money, and they need to live up to that expectations. And it's not even like an investor expectation, it's actually a mathematical expectation about what the money is gonna lead to. And so one of the observations that we've all had has been the fact that over the last 3 to 4 years, like 60-70% of the total value of the money that has been put into the market has actually come from American, the UK, UAE investors. I know that there's a counter argument that is also very important that probably Zach is gonna bring to the table, which is the role of local investors that are writing crazy amount of checks in early stage, and this is true. But this is a concurring phenomenon. So, which I'm also very positive about. So whilst I'm a bit negative about what is happening on the side of the reliance and dependency on American capital, I am actually being very positive by the number of organizations that have come up in terms of early stage syndicate, angel syndicate, early stage VC funds that are writing 50, 100, or like 50 or 100 deals over the course of the last few years, building pipeline for the later stage investors. But I think this concurrent phenomenon needs to be analyzed at the same time, because one leads to the other, and where it's going to be the capital at later stage, if it's drying up, and the perception of actually what African companies are doing is not as positive as it used to be, or the perception of the ability of all these investors from the US, for instance, to bring money into Africa is actually changing due to macro perspective, due to whatever is happening across the world. So I think these are some of the topics that probably get me excited. And then another one is the composition of the capital. There we've seen a crazy number of corporates entering the space, not necessarily through venture rounds, but also through expansion, to the setting up of facilities, through hiring, to creating capacity across the continent. The presence and the counter-cyclical role of DFIs and public money that enters the space is also being very interesting right now. A lot of the DFIs you can possibly think of anywhere in the world, from JICA to DFC to Norfund and FCDO, have proven to be some significant players in both early and early stage and late stage. Look at the IFC ventures. Look at some of the investment that are made by BII, etc., etc. So the presence of new players, corporates, DFIs, the presence of angel syndicates, the presence of rolling funds and funds that allow you to enter the deal flow at like $2,500 checks. These have, I think, concluding with a sort of tone of optimism, are concurring to creating a very diversified and strong ecosystem. And I think this is coupled with the fact that if you look at the numbers over the last decade or so, the ecosystem has just been growing. I think no matter what is happening in the last couple of years, the longer term trend is being very positive. Now there's a tricky conversation around the ability of later stage funds to return the money to their investors, which also need to be addressed. I don't think I'm the best person to address this, but I think over the course of the last decades, there's been tangible progress, and I'll leave this with you guys.
All right, thank you very much, Dairo. You raised a lot of points. Every year we debate how much did we raise. And I think ultimately most times the figures are typically close. I know, for example, like last year, Brighthouses was like 4.9, although, if you remove undisclosed, 4.6, while the big deal, which is Maxim, was 4.3. So 300 thereabouts. And yeah, there are some deals announced.
But there was also very transparent about like all these companies saying what the methodologies is. Once you actually add up all the methodologies, the numbers are all the same.
Yeah, that matters too. And also deals announced this year. And I'm like, hey, we heard about that last year, but I guess the rule really ultimately is until when they announce, really, it's not it's not yet a deal in a sense, I guess, or it belongs to that period. But it's fine actually. We'll just move on to Zach. So I didn't mention the name, but so I know earlier this year when we spoke, the approach for Launch Africa was to move very fast and invest in a lot of startups. And, based on, I think Maxim put out the charts where it's like one of the most active investors, Launch Africa. I'm curious, that was when we spoke in February, and, February, everything was still rosy. And then now I'm curious if, Launch Africa has still be going on based on that tempo. And just generally maybe some response to what Dairo said about like local investors and the role they play.
Yeah, thank you. Thank you, Daniel. I think the one thing I'd be, words can be very powerful. So I want to make sure everyone uses words rightly. So it's important to not classify us as a fund that invests fast, right? It's about investing with the right amount of time, energy, and resources for the right stage and nature of a business. So if you're a pre-seed or a seed startup that is pre-revenue or doing less than $25,000 in monthly recurring revenue, you don't need 6 to 9 months of diligence, right? So it's about doing stage and sector appropriate DD. So for a company that's pre-series A, doing less than, call it ballpark, $50,000 in revenue, a couple of POCs and pilots with some corporates, you don't need more than 6 to 8 weeks of time to do a diligence, because you're typically raising for about 6 to at best 12 months of runway. So it's about using the right time. So there's no such thing as fast or slow. It's about stage appropriate. It's a very important thing, because words can sometimes be misconstrued, and we know how difficult the African VC ecosystem is when it comes to comparisons. Yes. So yeah, we've done about just over 125 deals in our fund over the last 2 years. It's very important from our perspective, and as someone rightly pointed, to recognize that markets like Kenya, Nigeria, South Africa, and Egypt, the big four, I'd add Ghana to that as part of sort of the big five, because the big five is a nice word to use, have evolved in the last 5 to 6 years, to the last 7 years, to where they are right now. So we believe that as responsible investors, we have to be aware of what's happening on the quote unquote fringes, which is your second and third tier markets. 7 or 8 years ago, if someone told you or your family or friends that you were going to invest in a payments company in Nigeria, we all know what the reactions would be, right? Nigeria was an unheard of geography or region from an investment perspective into anything outside of private equity. But now Nigeria is obviously the leading region in Africa from a VC perspective. So you have to be aware of what's happening in the fringes, and these fringe markets will eventually become mainstream markets. And what are those markets? Markets like the DRC, Senegal, Cote d'Ivoire, Morocco, Tunisia, Algeria, and then others markets in East Africa outside of Kenya. So Tanzania with 60 million people, Uganda, Rwanda. So about just over a third of our investments are in the second and third tier markets. But it's important to understand what the right mix of population growth is, penetration of smartphones and mobile, internet and e-commerce penetration, and also the growth in consumer purchasing power. So we as a fund are very deliberate of how we make our investment decisions based on consumer product market fit validation, that we do extensive research on the ground as a team and through our partner networks. And I think several folks on this call that we partner with are an instrumental part of that. So irrespective of what market conditions, we are always on the lookout for good founders to back with relevant experience and that are solving real world problems. So as a fund, we have no intention to deliberately slow down our investment pace, but we will continue to make sector, stage, and product appropriate investment decisions into the next year, for which we will be raising a second fund. So, yeah. I think you're on mute, Daniel.
Oh, thank you. I was talking to myself. Thank you very much, Zach. Very helpful. The next question, I'll be going to Dr. Ola here. And so in Maxim's presentation, fintech is still the major leader. However, it appears that this year it's reduced. And I was thinking, and I'm asking myself, is it, and I think he might have hinted at it, but now in the fintech, there are a lot of fintech solutions embedded into other types of startups. And it now looks like, what do you put first as the startup, right? Is it a fintech? Is it agri-tech? What is it? And I know that, why I'm asking you this, because I went to HealthCap and I saw health and wellness, and I checked portfolio companies, I'm seeing some PayHippo and a number of you could classify them fintech companies. I'm curious, how do you think about the space? Technology, financial technology is basically an enabler for other sectors, really. But, how do you think about this in terms of like investing in companies, startups?
Sorry, I didn't quite understand your question.
So my question really is, there's a big overview about like, fintech and what is fintech or what should come first, based on what the company does, really. So you might be in agriculture, right? But are you crowdfunding first, or are you providing food, if you get what I mean? I'm looking at your portfolio company, and I know the major tagline is health and wellness. And I know you.
No, that's not true. Sorry. So let's start from there. I run a venture firm called HealthCap Africa, and we invest in two sectors. We invest in fintech and we invest in health tech and everything in between. So we've always been fintech investors, right from our very first fund, which returned a 25% IRR, which was one of the top performing funds, not just in the continent, but in the world. In terms of the percentile, and it was a specialist fintech investment firm, so 50% of the portfolio companies in that funds were fintechs. Since then, we've then gone on to have a sector focus, a thesis along fintech and health tech, and that's actually quite a common thesis to have. So if you look at the private equity world, for example, I think the private equity company is called Leapfrog, $500 million funds, again, in private equity space focused on these two sectors, fintech and health tech, because they're so complementary. And I just put a link up to the Healthcare Unicorns report, which we produced last year, which looks at health tech, and where we haven't yet had a health tech unicorn in Africa. So it looks at the unicorn producing sectors, shall I say, and obviously fintech is number one, but globally health tech is number three. So it explores the reasons why we haven't had a health tech unicorn in Africa, and perhaps what some of the solutions might be, and what a health tech unicorn in future might look like. And I think that you made a really important point about the relationship between health tech and fintech. So quite a number of our portfolio companies do have embedded finance solutions. So we've invested in a company, we did 7 deals this year. And our last fund, most of the health techs, so the ones that we did this year, for instance, we feel may evolve and into embedding some health tech solutions. But from our last fund, a lot of the health techs ended up embedding some fintech. So I'll give some examples from our portfolio. We invested in a company called LifeStores, for instance, which is a pharmacy tech solution. Just completed their pre-series A raise a few months ago, and we invested at pre-seed, and it started off as a pure farm tech solution, but then evolved into a farm tech solution with embedded fintech. So now, for instance, vendors can obtain credit for their medical consumables and drugs through their software as well. So that's a good example. Another one is Helium Health. Again, started off as a telemedicine solution and electronic medical record solution, but they also have an embedded payment solution and an embedded loan solution that caters for patients by helping them pay their bills, number one. In a lot of sub-Saharan African countries, 80% of payments for healthcare are out of pocket. That's difficult, particularly in countries like Nigeria, which also has the highest number of poor people in the world. So it helps Helium Pay, helps people pay their bills. It helps hospitals take payments online, and it helps hospitals also get access to credit. Because again, getting access to credit for hospitals is quite a specialist endeavor. In terms of being able to buy super expensive pieces of medical equipment. So that's one of the things that we talk about extensively in our Healthcare Unicorns report, how the space is evolving. And embedded fintech is definitely one of the things that one of the trends that we see for health techs. Now, do we think that every single company needs to become a fintech in some way, shape, or form? Not necessarily. I think that there's a lot of different sectors that don't necessarily need to embed. And we've had very successful health tech companies that haven't embedded fintech, but we see that as one of the trends. And even though we don't look across sectors, we really focus on health tech and fintech. As an angel, I invest as well. And I've seen embedded fintech as a trend, not just in healthcare, but across sectors. So it is a trend, but I don't think that every startup in Africa has to have some sort of fintech solution to be able to scale. And just in terms of that scale, because I know you mentioned, you contextualized your question from a point of, okay, what's going to grow outside fintech? Like, where are we going to see the exits? Where are we going to see these mega rounds? Where are we going to see these big companies? Because so far, most of them have been fintechs, but that's not unusual. So according to CB Insights, and this is another point from our Health Tech Unicorn report, nearly 1 in 5 of the world's 800 unicorns are fintechs. So even where there is developed payment infrastructure, even where there are a large proportion of the population that are banked, as opposed to Africa, where there's a large proportion of the population that are unbanked, even where people have access to credit, even with deep sorts of financial markets, stock markets, capital markets, you're still seeing 1 in 5 of 800 unicorns being fintech. So I don't think we're particularly unusual with that. But I do think there's other needs on the continent. And of course, I'm going to speak about healthcare. You know, you're more likely to die in the process of, a woman is more likely to die in the process of pregnancy and childbirth. And more likely to move, like Nigeria is one of the most dangerous places for a woman to become a mother in the world, more likely to die in the process of pregnancy and childbirth than Syria, than Afghanistan, and Iraq. So we have work to do on the maternal mortality front, and I think that technology can be an enabler for that. If you have your surgery on the continent, you're twice as likely to die compared to if you had your surgery in Europe. If you have a road traffic accident, you're 4 times as likely to die in Nigeria than if that accident occurred in London. So there's a lot of work to do in terms of sectors outside fintech, like health tech. And I think that we're kind of following a global trend with fintech sort of leading the way. But how does this all relate to what we all want, which is exits? I know myself and Maxime and Dario were actually in Cape Town, was it last month, the month before, discussing this topic of scale, because I think the main reason you're asking the question is because, okay, how do these things scale? How do they become unicorns? How do we exit? And we're excited about this $4.7 billion that has been raised. But that means that we now have about 40 billion to return at the minimum, hopefully more than that. And if you look at the American exits, about 20% of exits are via IPO. We only have, possibly unless something drastic happens with our stock exchanges locally, local listings are not really that much of an option. So foreign listings are sort of the only way that a company could IPO, and we know that Jumia is a good example of that. But the mainstay of exits are corporate acquisitions. And if you look in South Africa, where I believe 30% or just over 30% of all exits have occurred, you will find that they have a greater proportion of large corporates. So almost half of the continent's large corporates are in South Africa, and the rest are kind of scattered across Africa. So if we want these exits, and I'm going to finish on this, if we want these exits and we think that selling to, I mean, we've had 1 local exit now and 1 international exit. And obviously the international exit in terms of valuation was significantly greater, probably exponentially greater when we compare local to international exits. But if we think that the bulk of our exits are going to be local, then we need to start thinking very, very carefully about valuations. If we think, that the investors that are going to be acquiring these companies and paying this $40 billion for the startups are going to be local, then we not only need to think what will Google pay, or what will Amazon pay, or what will Facebook pay, but we also need to start thinking, what would Dangote pay? And what would Jimovia pay? And what would Tony Elumelu pay? And those are very, very different types of wealth, very, very different types of disposable income, and very, very different types of thought processes. So while Google might, pay $100 million for a company that's, maybe turning over $10 million, with Tony Elumelu.
You muted? Is she muted?
No, that was my last,
Okay. Oh, yeah. That's
my
a very,
effect.
that's a good one, actually, to think that that's the only situation that you mentioned these people, and I'm like, nah, it doesn't sound so exciting, right? In any other condition, and that's because you compared it with bigger players in quotes.
There's
So
always a bigger fish.
yeah, so certainly Dangote doesn't look so. Let me leave it at that. And yeah, very jarring, very interesting stats you've shared there. I would leave my house with more caution. But yeah, thank you very much. That's actually very, that's something actionable, because it means that it's not just, evaluations are not just taking a haircut just for haircut, but it's like towards, oh, how much would these guys pay? And it would be, I look forward to actually seeing those type of acquisitions. When you were talking about acquisition, I remember, Shell bought Daystar, but then that's still, external, and the figures weren't publicly released. But I'll just leave it at that. That's definitely very valuable. Thank you very much. Next question to Ido. And so I know that you spoke about, or you tweeted about, total addressable markets. And I'm curious, when you look at the regions, this whole period has been like a reset. Based on your portfolio companies and conversations you've had, how do you think it's affected the way people look at total addressable markets? Because I think that's something, for you to have written a whole thread about it, you must have definitely been very passionate about it, because that's a subject that will keep on happening, even with examples. Because we are seeing, I'm sure this year we'll probably see big four, but some countries will go up, some will go down. But that really sometimes an outlier. It's an outlier, investment that makes one country sort of like go above another, and then next year you're hoping. But how should people, from your conversations, total addressable markets, what are you seeing?
Let me try and make sense of it. Generally speaking, I think we are seeing now a very needed correction of a market that was overhyped globally. I mean, we are part of the globe in that regard. I don't think we're a special child. And the unfortunate reality there is that lots of assumptions were made on, on a lot of fluff. Let's use correct words. So people didn't really bother to do either due diligence from the investor side, nor too much work assessing who can they sell to from the founders side. And we ended up with, every deck starting with this is a trillion, this is $1 trillion market opportunity, and there are gazillion people in Africa, and they all need what I sell, and hence, I will be $1 billion company within 3.5 minutes. And it's all great on paper, and then comes reality, and wonders how does this translate into an actual value creation strategy, right? So numbers are numbers, and that's great, and valuations on paper, nothing is of value until it's crystallized. And crystallized mean until someone is willing to pay the price that you think your asset is worth, your company is worth, what you have built is worth. So that drives us back to how do you think about TAM, and rather than taking a very sort of, we're and it has little to do with the numbers of the year from an investment perspective, other than the fact that we're still fairly thin on data in the continent. So it is still extremely hard to come across not reliable numbers for any market analysis. And I think that we usually see sort of a very good preliminary top-down analysis when people approach this, but hardly ever see good bottom-up analysis saying, you know, when I think about what I know, here's how I structure my assumptions from the ground up and build to this whatever billions, trillions number that I suggest is addressable. And when one's builds a proposition that says, I want to raise 10 on 50, or I want to raise 20 on 100, you know, at a Series A, which was fairly common a year ago, right? That means that for us to Ola's point, we need to able to exit this thing at at least, you know, 1 to 2 billion to be worth to have it worth our time. That assumes very little dilution from when we enter and so on and so forth, right? So for investors like ourselves who need at a minimum a 10x return, if we enter at 50, that drives, you know, sort of a 750 to a billion valuation at exit. If we enter at 100, sort of 1.5 to 2 if you factor for dilution and for more capital requirements along the way. And I think this is where people come a little bit short on thinking, where they think about total addressable market, where they think about exit avenues at this point in time. We've had this year exactly 0 exits of north of $200 million, probably 0 at north of 100 million. And in general, in the last decade, we've had exactly 0 at over $500 million, debatably over 300 million. So we have not yet proven that there are people who are willing to pay billions of dollars for the companies here. I don't think it will not happen. I definitely think it will happen with time, but I think we need to be very reasonable and very thoughtful in the way we think about the pace of this maturing, and then how do we value ourselves? How do we build, a proof that the models work? Now, of course, when I speak from an investor's perspective, and I would like, each of the founders listening to price here his or her company at, 20K pre, and that I can buy half of it with 10. But seriously speaking, that's really not where I come from. Where I come from is, if we will not, we're in generation 1 of this ecosystem. Despite all we think, we have not yet proved much. We have proved that there is demand in market. We have proved that we're able to start building. We have proved that we're able to find and grow local talent to an extent. And I think we have proved that there is definitely a potentially very high upside, but we have not yet proved that we can do a full cycle, that we can take tens or hundreds of millions of dollars and return them at high multiples. And if we fail to do it, there will not be a second chance for us as ecosystem, not for me as a fund manager. And hence, while when an investor says something like this, you need to rationalize and so on and so forth, it is not just speaking from a position, it is also thinking from an ecosystem perspective, that if we will fail to demonstrate that we are on par or better than other ecosystems from a return perspective, and other ecosystems being the Silicon Valley, Tel Aviv, Beijing, Shanghai, Bangalore, and so on, we will not get the monies we believe we should be getting. I think a lot of people got hit on the head in the last 6 months. I've looked at the numbers from Maxime earlier. Yes, the year-on-year numbers are good. If you look at the second half of the year, we're dramatically down. We're probably at about 2/3 from what we have, probably 40 to 45% down from what we have seen in 21. We're actually pretty close to what we have seen in 19, not even in 20. If we look at the numbers of deals of Series A and up, the number of deals, or sorry, Series B and up, we're on par with 19. So we're slightly going backwards on the belief of people that things can really grow here. You know, we have a lot of people believing in the dream and less people believing in the substance. And we now need to go back to market and show them that there is substance for which we should be reasonable and sensible in how we think. We should dream giant dreams, right? We should be as ambitious as any other ecosystem, if not more. I think the potential is never ending, but we should get the first cycle right, because it will be very hard to get a second chance.
Thank you very much. That was quite a passionate speech. And I like that you acknowledged, the possible bias that, people might allude, but just talking about how it's important for the ecosystem, because ultimately it sort of just catches up with startups, even if you come up on a very high valuation. Thank you very much. Zach, so next, I know Dr. Ola mentioned one of the ways exits can happen is mergers and acquisitions. And there's been a number of them this year. But typically a lot of these deals don't come with a price tag, but it's still very valuable because it gives exit opportunity. I'm curious, how you look at the landscape, Anglophone versus Francophone? Many of the deals I know of are Anglophone, but what does that landscape look like and how do you see it?
Yeah, I mean, so just to piggyback on a couple of points that Ido made, which I really liked, we haven't ever since Paystac's acquisition by Stripe, that was a $200 million acquisition, but people forget that, that acquisition was part cash, part stock. So the actual market value of the acquisition was north of $200 million because Stripe's stock really went up after that. So, but again, it's a number here, a number there. But the reality is we haven't had outside of Paystack, we haven't had a significant, $100 million plus acquisition in the tech VC space. What we have had though, which is, I think, needs to be spoken about here, that Maxime and both the Maxes from Big Deal wrote a great piece on, is the fact that, we've had more than 100 exits in the last, 3 years, Maxime? Since 2019?
2019, yeah.
2019. So we've had more than 100 exits. Now, a lot of those exits are they're either stock purchases, not cash, or a combination of the two. A lot of them are not disclosed from a deal value perspective, but the reality is exits are happening, right? So that's point number one. Point number two is we're going to see a significant amount of, if you look at the history of bull and bear markets, even in the private sector, there's usually a period, there's a lag about 6 to 12 months from the start of a bear market where industry consolidation happens. So we're going to see a lot of horizontal M&A happening next year and the year after. This is just our, I wouldn't say prediction, but our gut feel. You're going to see the dominant players in Africa in particular verticals. So for example, supply chain optimization and retail tech, it's a broad term I'm using. Companies like Trade Depot, Market Force, Wasoko are going to start expanding into other African countries, not necessarily through organic growth, but through M&A. It just makes more financial sense. So you'll see a lot of consolidation over the next 2 years. That's our gut feel. Similar thing with payments, similar thing in the remittance industry. And I think that to me it augurs well, because that then says to me, if you're investing in non-core markets, I mentioned earlier, second and third tier markets, there is a path to liquidity through a sale to a dominant player in Nigeria, Kenya, South Africa, Ghana, or Egypt. And that to me is pretty attractive. So I will see, I'm us, the ecosystem, I see a lot of hope from an internal consolidation, a horizontal M&A. We are also going to see large corporates in Africa, especially insurance companies, retailers, and banks, and the telcos, start to be more serious about M&A. M&A in corporate South Africa, and Ola made a good point about, how South Africa tends to be a little different from the rest of Africa when corporates get involved in the startup scene. In my experience over the last 12 years in Africa, corporate M&A activity tended to be more defensive. So they would acquire something out of either, oh, geez, I don't know what's happening in this space. Maybe we should look at acquiring some of their customers. It used to be more defensive. As a result, you would pay lower multiples. So if you look at the big names like the Old Mutuals, the Naspers, the Standard Banks of the world, the MTNs, the acquisitions were more from an acqui-hire perspective. It was more from, vertical M&A wasn't really well structured. Some of the biggest corporate acquisitions of the last 3 years in the fintech space in Africa didn't turn out that well. If you just look at the likes of SnapScans and 227s that were bought up by Standard Bank and Old Mutual respectively. This is all public information, so there's nothing to hide here. Those companies could have done significantly more had they not been taken over by a large corporate. So there's been a certain amount of maturity within corporate M&A divisions about why acquisitions should happen versus acquisitions happening for the sake of, FOMO or acquiring customers. So I actually am quite bullish about the level of M&A that we're going to see in the next 2 years. Will the multiples be as high as what we expect? Maybe, or maybe not. But I see consolidation both vertically and horizontally increasing in the next 2 years. And needless to say, secondary exits should continue to be a source of liquidity. Unless you have examples of pre-seed, seed, and Series A investors being able to get liquidity at later stages, you're never going to see that funnel, or call it the sausage factory of companies, making it up to Series B and Series C, where funds like TLCom, Partech, Africinvest, and the other bigger funds on the continent can find attractive deals, right? So you need to create liquidity at the early stages. So secondaries will and should continue to be a source of exit opportunities for GPs, but by definition LPs and then angels. So those are some of my thoughts around the liquidity question.
Thank you very much, Zach. I think something very instructive that you mentioned is that we might not hear about them. The figures might not be disclosed, but the exits are happening, and even more than captured actually. So if we think a lot are happening, there are way more that are happening that we don't hear about, or we'll probably hear about next year or 2 years after, and it's happened already because it's probably not in the best interest of the parties involved to announce it, maybe. But thank you very much. That's
the one thing, just to add to that, the one thing that you certainly will not hear is secondaries, right? So Flutterwave's massive Series C round last year, Kuda's round, all the big rounds, founders are under no obligation to disclose the amount of secondaries.
Yeah.
Right. So what you hear is primary. What you don't hear is secondary. So you can't discredit how important secondary exits are, because everyone sticks to their lane. There's a limited amount of value that an angel investor investing $50,000 when a company's pre-revenue or just post-revenue can create at Series B. So it's fully deserving that early investors get liquidity and convince the ecosystem that there is a clear path towards scaling. So just because you don't hear about secondary exits doesn't mean they don't happen. And maybe another good project, which is extremely hard to do, would be doing a proper analysis of secondary exits. But for that, you need literally every player to be able to disclose secondary figures. But good luck with that happening. It's not getting angels to tell you how much money they made and who they sold to. Yeah, that's a $1 billion company that you can sell to Bloomberg, but no.
Daryl, Maxim, that looks like an idea to check.
Yeah, I have a little bit of time on my plate. I'll start doing that.
Yeah, but just to Daryl and Maxim, do you want to touch on the M&A? Any thoughts, anything you want to share? Any addition?
Yeah, we did a little post about that and started adding this data in our database a couple of weeks ago. And I mean, as Zach shared, we don't necessarily know how good these deals were each time, but we know, a little bit over 100 have happened since 2019. We know that 80% of them took place in like the big four markets. What's interesting is to see that there's a disproportionate amount in South Africa versus other ecosystem, while there's maybe less funding going to South Africa than in Nigeria or Kenya, but there's more liquidity events. So that's an interesting takeaway from this past 100.
Why is
That's a good question. I would love to get Zach's and Ido's views on that, but it's a fairly clear difference. I mean, the share of exits in South Africa versus the share of funding that is raised by startups is where. So
I think that I mentioned that before, that in terms of the share of large corporates, South Africa is just a lot bigger. So there's 400 companies in Africa as at 2015. If you read the McKinsey report called Lions on the Move, that make over $1 billion. So 400 companies in Africa that make over $1 billion. That sounds exciting, but when you dig through the data, you find almost half of them are in South Africa. And when you go down a level to corporates making $500 million or more, there are 300 in South Africa and only 56 in Nigeria. And then even when you look at stock exchange size, which is capital market depth, the number of public companies, etc., the size of the Nigerian stock exchange is about in the range of, depending on what, whether you use the street rate or you use the CBN rate or you use the people that are going to the Saudi Arabia rate or you use the, there's about 6 rates for different types of people in Nigeria. But if you take an average of the rate, it's probably around $50 billion. So when I ask what's the valuation, what do you reckon that our stock market, the South African stock market, the Johannesburg, is compared to Nigeria? People say it's double. Some people say triple, some people say like 4 times. But while Nigeria is at 50 billion, the Johannesburg is at 900 billion. So there's a massive difference in terms of large corporates that can acquire, and also valuations are lower in South Africa compared to Nigeria on the average. So there's less funding being raised in South Africa, but their corporates are much bigger. Compare the biggest Nigerian bank to the biggest South African bank. Compare the biggest Nigerian insurance company to the biggest South African insurance company. And you find out that on a macro level, the economies are by and large the same in terms of GDP. But on a micro level, look at the number of millionaires, look at the amount of disposable income, look at the number of big companies. South Africa really, really rules Africa. I can remember looking at the figures from ShopRite when they left Nigeria. This is a big South African supermarket chain. They were making more money in South Africa than all 9 other African countries put together.
Yeah, it's a fantastic point, Ola, and I think that needs to be shared a lot more across all our different ecosystem players. Absolutely. 100%.
I'll link it down below. Actually, the report is called Lions on the Move by McKinsey.
Yeah. Thank you. The Nigerian in me is just like, but it's fine. The facts are the facts. Daryl, I don't know if I know Maxime, you were talking before I said why. You want to finish your thoughts? Anything
no,
more?
I think Ola definitely answered that point in very, very valid way. The only thing I would add as well was to highlight the fact that more and more of these M&A and exits are happening, as Zach said, basically as a consolidation, so between startups. We're seeing that quite a lot, especially in Egypt, for instance. There's more and more of this taking place. I think Appetito, for instance, was just merged with another startup. It was announced a couple of days ago. And so, yeah, we're seeing more of these, and we definitely believe there will be more of these in the coming months. So, yeah, that might be another sort of wave of M&A taking place there, usually acquire. So, yeah.
Thank you very much. Daryl?
I mean, So I think perception is very important, and case by case analysis is also very important. And I know there's a tendency to associate the fundraising operation, it being an M&A or an actual round, as a success. But especially recently, we've seen a M&A happening for companies buying shares very cheap just to save up, like just to save some companies from complete failure, or many companies that are actually doing down rounds. So from a perspective, I studied development. My interest is in socioeconomic growth for countries in general. So when I look at the aspect of access to finance and the expansion of access to finance to organizations and people that previously didn't have access to finance, I think what is happening is great. The diversification and the improvement to access to finance. When you look from a case-by-case perspective, and you actually look at why some companies are raising, or why some companies manage to, or the fact that some companies manage to sell their shares or sell some of their team in an acquire situations, not all of them equal or coincide with successes. Okay. So I think it's also very important to look at that. Anything else that has been said about the viability of M&A, about the fact that acquisitions are probably more viable for many companies and use cases across Africa, all stands. And I think I don't need to repeat it, and it's been extensively discussed. Yeah, I think corporate can offer great opportunities, but also not necessarily they can also bury within their bureaucracy and within their processes fantastic ideas that could thrive otherwise. But I think it's very important to understand the perception. Like, perception can be tricky and can be misleading when it comes to understanding the real value of a fundraising exercise, it being an normal round or not. It's not always rosy, and it's not always a success. Sometimes it's an extreme exercise, an extreme action that is taken from investors or from other companies to save and take advantage of the cheap price of certain companies. It doesn't equal necessarily success.
Yeah. Right. Thank you very much. Thank you, Dairo. We're right about at the hour mark, so we're wrapping up now. But just ask. I know people are sending questions, and I'm asking them, so we might wait a few minutes if there are any important questions that you would like to ask. You can just send them via the chat box. So this next question, I think Dr. Ola and Aido, you can take it. So someone's asking, Lydia, I believe, how important is it for LPs that fund African VCs to be local? Or is it a cry for local LPs? Or is this cry, is it majorly ego-driven, or like just, symbolic? Is there, what's the value to this request or this? Yeah. I think she's... So
I wish I understood the question. Can you kindly try and repeat it?
So she's basically saying, how important is it for the LPs that fund African VCs to be local? Is this from an ego perspective? Maybe you just want more Africans or locals to back the funds, or is there, she's basically asking, what's the value to this?
Each LP is entitled to have his or her own views. I would say, generally speaking, that most LPs that I know invest for returns rather than for the sake of humanity. So in which case they care about the teams that can return them the most money. Of course, DFIs potentially, I wouldn't say they're a big exception. I would say they're a slight exception to the rule, because they have development goals and some commitment to a region that is above and beyond a usual commercial LP's commitment to any certain region. But I can tell you that when I speak with Hamilton Lane, which manage only, if I recall correctly, 700 billion in LP's money, they don't care if I'm, an alien from Mars investing in a parallel galaxy. They need to see a higher return than peers. That's it. So I would definitely argue that there is a ton of value in being a local manager in this context, because you won't be able to identify the best deals otherwise. I would strongly argue that what we have seen in 21 is a great testament to that. But I don't think that it's, you know, a PR or whatever. You know, there is substance in the fact that being, you know, VC is a local business, has been and will be in all jurisdiction from when it was started. It never worked otherwise, or hardly ever worked otherwise. There is a reason why Silicon Valley investors invest mostly in Silicon Valley, and why, you know, the best Israeli deals are done by local VCs, and same in India, and so on and so forth. So that is the way to frame it. I don't think I think the way it is framed in the question is I'm not sure that I understand it.
Yeah, so that's a very, you know, valid response given. So I just looked at the question, and the emphasis is LPs. So I think it's basically the persons who basically saying Africans or locals, how important is it for them to actually fund the firms, basically. That's it. So I think you're speaking of.
Sorry, I was just, sorry, they've just taken, like, I'm in Lagos, so I apologize on behalf of the Nigerian power system. Well, my laptop is still working, so let's go. What is it about local LPs that make local LPs special? So I've raised from local LPs, I've raised from international LPs. And I think the reason why people want local LPs is really for several reasons. Number one, as anybody that has done business in South Africa, or anybody that has done business in Nigeria can relate to, they'll give you money in Naira and they'll give you money in Rand. And that means that it's easier to return than US dollars. At the beginning of this year, my balance sheet said that $1 was equal to 400 Naira, and I was sure of that fact. By the end of December, it could be 1,000. So if you raise a Naira funds, then you give back to your, you exit in Naira and you give back to your investors in Naira. So the first fund I raised was partly Naira. And that meant that I could provide a fantastic return to my investors. In fact, people think that now that VC, my local investors think that VC is the only asset class to invest in. Because I collected money in Naira and returned in Naira. And if you collect in Rand and return in Rand, then everybody will think that it's the best thing to do. But today it's very, very difficult for a Nigerian company to raise money in dollars and return an exponential exit in dollars if they're not exporting and they're not sort of producing a product for Europe or America. And the reason why is because it's a moving target. I can't tell you, despite all the economic calculations I like to do, I cannot tell you how much a dollar will be worth in Naira by this time next year. It could be 800. It could be 1,500. It could be 2,000. It could be 5,000. Who knows? So I think that's one raising in Rand. And the same when I went to South Africa. The first time I went to South Africa, I changed dollars for 8 Rand. Now I'm changing dollars for something close to 18. And this is all in the space of like a decade. Soon it's going to be 25. Maybe at some point it's going to be 30. So when you have a moving target, if you have local LPs and you have a bit of Naira in your fund, then it's easier to return your funds. Number two, there are all kinds of, when I say, like when I talk about doing business in Nigeria, I talk about two sets of forces. I always say that when you're doing business in America, you only have one set of forces, market forces. When you're doing business in Nigeria, you have two sets of forces, market forces and evil forces. And sometimes you can actually spend 80% of your time, even on the evil forces, and only 20% of the time on the market forces. So local LPs can also help fight some of those evil forces because they're well connected, they know the regulators, they know the environment, they can make phone calls that an international investor in Silicon Valley can't. So I think that's where local LPs have helped as well. In terms of deals, they can put together deals with corporates. Most of the LPs are old men sitting on the boards of like 5 stock exchange companies, right? So they can put together your deals for you. If they're on 5 boards of big companies, on the boards of banks, then they can, you know, help to move an acquisition forward if you give them a call. Number 3, and I mean, this might be a bit selfish because I'm in Nigeria, but one of our biggest problems in Nigeria and South Africa and Ethiopia is capital flights. Whenever there's an exit, then we have to repatriate those funds to America. We have to repatriate them to Europe, and that's great, right? And that was how America was built. Money came from Europe, it built the railroads, and when there was a return, they returned it back to Europe. But for us, it's a different dynamic because our currency is not like a reserve currency. So when we repatriate funds, then the level of our actual currency goes down. So if we can keep more currency in the continent, then it prevents capital flight and promotes economic growth. But I'm still going to go to the point that Ido made again, that this game is really about returns. It's about being able to exit. And you can exit via acquisition, you can exit via, you can exit via IPO, but there has to be an exit at the end. That is why everybody is putting money. That's why any LP is giving money to you, for you to achieve an exponential exit. And it has to be an exponential exit because US Treasuries are now 6%, which means that you have a risk-free return where you can close your eyes and go to sleep of 6%. So if you're paying a fund manager a management fee, and you're taking the risk of investing in a fund that can go to zero, then they are expecting not 2x, not 3x. No investor wants that. No institutional investor wants that. They can get that risk-free. If they're taking that risk premium of startups, so they want an exponential exit, and that has to come either by acquisition, maybe sometimes by secondaries, but generally by acquisition or IPO. And for a company to IPO and for the investors and shareholders to believe in the company, it has to be doing significant revenues, right? So those are some of my ideas about local LPs and how they help. But at the end of the day, I still agree with Ido and submit to the original thing that he said. The game is about returns.
Thank you. You just made local, I guess anybody listening on this call would rethink, they would probably reach out to you to get to those old men, right, as LPs, right? Because it just makes life easier, actually, from all you've said. And yeah, thank you very much. We're right about wrapping up. I feel like this is like a consensus, but Ropa is still asking whether the investors believe that valuations in Africa are inflated. Are the down rounds happening? The down rounds are happening? Are they justified? And I know this is a bit nuanced, but because it depends on sector and company. But anybody want to just touch on that? I have an opinion, but let the investors speak. Anybody?
Okay, I think it's a tough one to answer. So I some are and some aren't. It's it's a little bit some companies were overvalued and some were not, and it's a tough market right now. And generally, down rounds are an unpleasant event in any company's life, by the way, and most of its investors' life as well, because you need to mark out things. So look, it's a mechanic to go through, and I think it's a good reminder to everyone to try and not overprice at the round they're at right now to avoid it in the future, and that you don't create too much of a gap to grow into. It is easier to get higher valuations in the earlier stages at pre-seed, seed, and pre-A. It is harder to do so in a B and a C, where you're actually priced on your real growth, not just on your prospect. So I don't think there's a good answer to whether it's justified or unjustified. Who knows? And we need to be very specific. But I think it is a reminder to the fact that it may happen, and it's something to think through when you're pricing for your current round.
Right. Awesome. All right.
Just add something quick there that can you guys hear me? Is with the market corrections, it's important to understand that, to Ido's point earlier, when you get priced at Series A, B, and C, all your safes and your convertible notes convert. So the caps on a lot of the safes and convertible notes, and this is where we play a big role, are different depending on how much value an investor adds and non-financial value add, etc. But going forward, you're going to see the vast majority of safe notes and convertible notes will have MFNs, so most favored nation clauses. Just for people that don't know, it's basically a way in which if there is a down round and valuations at the price rounds are lower, then the cap gets adjusted for previous rounds and it gets retroactively lower too if there's a down round. So you're going to have MFNs becoming almost a must-have and not an optional. The vast majority of safe notes in the last, not just 2, but the last 4 to 5 years have not had MFNs. And now you're going to see founders as well as investors saying, hey, I'm not going to give you a safe unless there's an MFN, and it protects you again. So it almost encourages founders to say, hey, let's not overprice this round just because we're crowding in some big names. Let's get a realistic valuation cap as a multiple of either our ARR, our transaction volume, a number of monthly active customers, whatever metric is relevant for your sector and product. And that's going to be, I mean, like us as a fund, we rarely will do safes without MFNs going forward. And that's a good lesson that the industry has taught everyone.
Thank you very much, Zach. Thank you so much. I know that this question is directed to Dr. Ola, who's jumped off the call, but I was hoping to get around the subject of women-funded startups, which, as Maxime actually shared, it's like hovers, it's pretty much low. And I know it's a bit nuanced because, you have to invest in an investable company, whether it's male or female. But I think there's always going to be that question of how can we increase the participation or the support or the funding rather that goes to women-led startups. And I wonder if there are any ideas or anything worth restating. Zach, Ido, anyone?
By having more women allocating money, period. Nothing else will crack it.
Yeah, I mean, I've been I was on a panel just recently as well, and I'm just surprised. I mean, so Launch Africa has a sister fund called 535 Ventures. For those of people that don't know, that is exclusively focused on backing women co-founded or women-founded startups across the African continent. But to Ido's point, like women family offices, women-run corporate venture arms, women angel investors need to start becoming LPs in funds, angels in funds. So you can't expect, I saw an interesting stat the other day, can't remember where, but if you look at female LPs in the US and Europe investing into funds, the vast majority of female LPs invest in predominantly male-run funds. And I've always wondered why. I don't have an answer to that. So, we need to have some sort of a course correction saying that there needs to be, and there certainly is no shortage of potential LPs that are women. So the education needs to go from founders to GPs to LPs. The diversity and inclusion from a gender perspective needs to go entirely up and down the value chain, not just at the founder level.
Oh, thank you. That's a different take to it. I mean, most people will come from the founders where you're coming from. That's very, I think that's the last question. Daryl, do you have anything to add? We're wrapping up with this. Anything to add?
I think, I mean, we could add, but I think everyone
All right.
But it was great to see you all before Christmas, guys.
All right. Thank you very much, Daryl. Thank you, everyone, for joining. Come to the end of the session. This was very insightful. Got a lot of interesting ideas, and my perspective has been expanded. Thank you, everyone.